good morning for those on the West Coast. Good afternoon for anyone that's tuning in from anywhere to the east. Today, we're going to be covering the Employee Retention Tax Credit. Our session's titled Maximizing Savings with the Employee Retention Tax Credit. My name is John Leathers, and I'm Executive Vice President of Product and Revenue here at Trusaic, and happy to be leading the session for you all. So in terms of a little bit about myself, before we dive in, I've been with Trusaic for around 10 years. And during my time here at Trusaic, have had the opportunity and the privilege to participate in providing strategic workforce solutions for a variety of employers throughout the US as well as internationally, all centered around the central themes of tax credits, compliance, anything and everything to do really within the HR space. And so to date, we at Trusaic have assisted more than 1,000 clients throughout the United States in claiming the Employee Retention Tax Credit. And so definitely pleased to be able to be here and share a little bit of those learnings, knowledge, and information with you in terms of being pulled from those experiences. So in terms of a high-level agenda, what we're going to be covering today is, number one, what is the Employee Retention Tax Credit? Clear up any confusion that may still exist around the tax credit. Secondly, we'll be focusing on minimizing any risk of IRS audit in the context of claiming the Employee Retention Tax Credit. There's some best practices that we can apply and to make sure that we're not exposing ourselves to any problems with the IRS if and when they have questions about the filing. And thirdly, we'll be talking through the mechanics of actually claiming the credit. So with that said, let's dive in. So what is the Employee Retention Tax Credit? And before I dive in, the last thing I'll share is that we will have poll questions throughout the session. In addition, if you have questions as we go along, please feel free to submit those into the chat. And at the end, as we get towards the end of the session, I'll do my best to, number one, either address those questions at the end of the session, or if we don't have time to get to them, we will circulate answers to those questions to the group. So first order of business, very high level, what is the Employee Retention Tax Credit? What it is, it's a tax credit for employers that paid employees during the COVID-19 pandemic. And so it's a government stimulus program that was passed by Congress to help prop up key sectors of the economy, namely smaller businesses, generally speaking. And so the credit is quite potentially financially lucrative. It's up to $26,000 in tax credit that are available per employee. The credit applies for the 2020 and the 2021 tax year, and it can be claimed retroactively, obviously, otherwise we wouldn't be having this session. The Congressional Budget Office estimates allocating around $80 billion to this tax credit. And so the funds that are available are quite substantial, and it's critical that employers act quickly to be able to claim those. There are deadlines on being able to claim these credits, and the first of those deadlines is pretty rapidly approaching. In just a few months here, the first deadline to claim the first retention credit for the second quarter of 2020 will be approaching. We'll get into that a little bit later in the session. One of the really interesting things about the Employee Retention Tax Credit is that it's considered a refundable credit. And what that means is that unlike other tax credits that are simply that are able to be used as offsets against future tax liabilities, a refundable credit is actually issued as a check that goes straight to employers, and it can be larger in monetary value than the taxes that it's designed to offset. So the Employee Retention Credit is designed to offset the employer's share of payroll taxes. But because of the way that the credit calculation is structured, the way that it was structured by Congress, again, the money that you get back in a check from the IRS can be larger than the payroll taxes that it's actually offsetting. And so usually a couple questions come up when I do have conversations with employers in a more one-on-one setting, and those questions tend to be along the lines of, why is that? What's going on with this? And really, the reason that is that Congress was looking for vehicles to inject money via fiscal policy stimulus into the economy. And so this was a easy way for them to be able to do that, to be able to facilitate that policy goal. And so one of the questions we get for folks that are familiar with the PPP loan program, the Payroll Protection Program loan, many employers did participate in that program, are there any limitations in terms of how the employee retention credit can be spent? Because for those that participated in the PPP loan program, there were limitations on how those loan proceeds could be spent. They could only be spent on payroll or qualifying non-payroll expenses like rent or utilities. So the great thing about the employee retention tax credit is that there is no limitation on how those funds can be spent. And unlike the PPP program, the employee retention tax credit is not a loan. It does not need to be paid back to the government. And so for those reasons and others, many consider the employee retention tax credit to be, even better stimulus than the PPP, and advantageous financially to organizations looking to prop up and strengthen the balance sheet. The credit is available to for-profit, nonprofit entities, as well as some government employers. And importantly, this was a big point of confusion, particularly early on. Companies can now participate in the employee retention tax credit program, even if they participated in the PPP loan program. Now, originally that wasn't the case, and Congress amended the ERC qualification rules towards the tail end of 2020. And so because of that, now employers are able to participate in the employee retention tax credit. And in fact, I would estimate that roughly 60% of the customers that we've assisted with the ERC program have taken at least one PPP loan. And so we're very confident in that employers can substantially financially benefit even if they took PPP loans. A little bit later in the session, we'll get into some of the interplay between PPP loans and the employee retention credit that are important to consider. But for now, the big takeaway is the PPP loan program was great. You are able to participate in the ERC even if you participate in that PPP loan program. And unlike the PPP loan program, ERC funds do not need to be repaid to the government, and there's no limitations on how they can be spent. So let's talk a little bit about breaking down that $26,000 per employee maximum that we talked about. And so the way that actually breaks down is that for the tax year 2020, employers are eligible to claim up to $5,000 per employee. And the way that breaks down is it's 50% of the first $10,000 in qualified wages for the year per employee. And then as we move into 2021, you can see that the total credit amount, the total hypothetical potential credit amount per employee increases pretty dramatically. It increases to $21,000 per employee, and that breaks down to actually $7,000 per quarter through the first 3 quarters of 2021. And so at 2021, you're able to take 70% of the first $10,000 in qualified wages per quarter per employee. And so you add those together, you get a total of up to $26,000 per employee. Now, I want to spend a little bit of time here on the right side of this table and talk about the definition. What are qualifying wages? What wages are allowed to be used, and what needs to be true about you as an employer in order for you to be able to say that certain wages are qualifying wages. And so one of the themes that you see is that moving forward from 2020 into 2021, the IRS made it easier to qualify for the credit. They made it easier to be able to say that wages are qualifying wages, and they also increased the credit amount. And that was reflective of just their policy intentions at the end of 2020. Again, looking to find ways to be able to accelerate their fiscal policy stimulus goals. And so for the 2020 tax year, if you had less than 100 full-time employees in 2019, then you're able to claim wages paid to employees as qualifying wages paid to all employees. Now, and if you had over 100 full-time employees in 2019, then for the 2020 tax year, you could only use wages that were paid to furloughed employees as qualifying wages. And so one of the themes is that for purposes of the employee retention credit, it's definitely better to be considered a smaller employer. Now that size threshold was increased as we move forward into 2021. So if basically if you had less than 500 full-time employees in 2019, which is always the baseline year, you'll see that as a recurring theme, then in 2021, it's wages paid to all employees that are qualifying wages. And you're still able to claim the credit if you had more than 500 full-time employees, but you can only claim that credit with respect to wages that were paid to furloughed employees. So again, it's better to be smaller. And for 2020, if you had less than 100 full-time employees in 2019, you were considered small, and therefore you can use all wages paid to all employees as qualifying wages. For 2021, that threshold gets easier. If you had less than 500 full-time employees in 2019, you're able to qualify as a small employer and use wages paid to all employees. Now, one thing I'll just comment on is this full-time definition. The way that the employee retention credit defines full-time is they actually point to a different section of the IRS code. And the section they point to is a section that actually deals with the Affordable Care Act's large employer mandate. And so employers are required to use the Affordable Care Act's definition of full-time for purposes of measuring whether they fall into this 100 full-time or 500 full-time threshold. And so that's something that's important to ensure as part of the project steps that you've appropriately performed that calculation. Now, if you know you're well below that threshold, let's say you only issued 50, 60 W-2s in 2019, then clearly there's no way that you're over 100 full-time employees. But it's as you start to get closer to those margins that it's critical to perform that calculation accurately. So let's go through some examples here, just in terms of companies and sizes and how much credit these are generally examples from real customers of ours. So we support customers across a variety of employee sizes, and so the point on this slide is that even if you only have a small number of employees or small number of employees that are considered to have qualifying wages, the employee retention credit can be incredibly financially lucrative. We've been doing tax credits for the last 22 years, and it's very rare to see a tax credit come along that has this kind of potential financial impact. And so on that first bullet point, a company with 5 employees that experienced declines in their gross sales was able to generate a credit of $60,000, and that's cash right in their hands, the check that the IRS mails to them. Second bullet point, employer with 10 employees, they only had a decline in their gross sales for 1 quarter, and they were able to generate a credit for $70,000. And that theme continues down to that bottom bullet point where you have a company with 100 employees that was subject to this COVID suspension order, meaning they had to, as an example, they had capacity restrictions on the number of people that they could seat inside. And so they were able to claim that they were affected for the first quarter of 2021, and they were able to generate a credit of $850,000. So the credit can be very financially impactful. One item I'd like to point out too is that there are companies that believe they don't qualify because they believe they're too large. And so, as an example, this is a real example, a client of ours that was a client on a different product, and they approached us. They have roughly 1,400 employees across 35 different restaurant locations in Southern California. They were originally told by their CPA firm that they weren't going to be able to really qualify for the retention credit and generate any meaningful tax credit because they were too large. But once Trusaic actually accurately applied the IRS look-back measurement method, that Affordable Care Act full-time determination method that I referenced a slide earlier. Once we accurately applied that company, although they had 1,400 total employees, the reality was that a very large amount of those employees were variable hour part-time employees, and they only had 370 average monthly ACA full-time employees during the 2019 tax year, which actually allowed them to be able to claim the tax credit in 2021. And so again, it's just critical to have a deep, thorough understanding of the tax law that applies so that you can make sure that you're not leaving any money on the table. And nothing against CPAs and bookkeepers. We have very good partnerships with hundreds of CPAs and bookkeepers throughout the U.S. But oftentimes they're not specialized to deal very deeply with a very niche area like the employee retention credit, and that's why they turn to us to provide value. This being one example of that. So we've hit our first poll question, and the first poll question that we're going to poll here is: did your business incur a decline in gross receipts, i.e. gross sales, during 2020 or 2021? And to be clear, that's comparing 2020 or 2021 to 2019. So I'm going to hit this poll here. I'm going to launch the poll, and actually that's a test. Let's see here. Let's see. One moment, bear with me here. And I think that option one we'll just use as our yes, and option two is our no. And I'll let the responses pour in here. We'll give it another 10-15 seconds here. All right, it looks like we're at roughly 75% of attendees are saying that they did experience some kind of a decline in their gross sales, and around a quarter to a third, it's shifting a little bit, are saying that they did not. So we're going to end that poll. We're going to continue on. So thanks for that. Before I move on, one thing that I will note is, again, it's really important to realize that even if you did not experience a decline in your gross sales, it is still, depending on industry and depending on your particular facts and circumstances, it's still very possible that you can generate a substantial tax credit. As an example, roughly 50% of our clients did not experience a decline in gross sales. Many even had record sales, but because they were operationally impacted, where they had portions of their business that were forced to change or alter operationally. As an example, having capacity restrictions if you're a restaurant, or being forced to change your operating hours. A proper application of the operational impact portion of the employee retention credit will allow an employer to claim the tax credit, even if they did not experience a decline in their gross sales. So that's a key point to take away. And that flows right into this framework here, right? So there's two core ways to qualify for the employee retention credit. And the first is, did you experience a decline in gross sales? We'll unpack that a little bit here shortly. The other is, did you have full or partial suspension of operations? Many people get hung up on the word suspension. A different way to think about this is just, were my operations impacted in some way due to COVID, due to government mandates that were issued because of COVID? And so let's unpack this first test here for a moment, the decline in gross receipts, i.e. gross sales. So in order to perform this test, what we're doing is we're looking quarter by quarter throughout 2020, starting with the second quarter of 2020 and through 2021, ending with the third quarter of 2021. And we're looking quarter by quarter to see whether there was a decline in gross sales when you compare to the same calendar quarter in 2019. So the first test that takes place for 2020 is I take the second quarter of 2020 and I compare it against the second quarter of 2019. And if that quarter declined in gross sales by more than 50%, then I'm eligible to claim the retention credit. Same test applies for the third and fourth quarters of 2020. Now in 2021, remember I said the IRS, they made it easier to qualify and they increased the credit amount. And so you can see here, this is an example of them making it easier to qualify. So for 2021, you only have to have experienced a decline in gross sales of at least 20%. So when you compare the first quarter of 2021 to the first quarter of 2019, if you experience a decline in gross sales of at least 20%, then again, you would qualify for the retention credit. So that test happens quarter by quarter, and the threshold to qualify gets lower. It gets easier as you move from 2020 into 2021. Now, remember, that's great to be able to qualify via decline in gross sales. The reality is that you don't have to have had a decline in gross sales to qualify, because there is a second test that is made available. And so, roughly half of our clients did not experience a decline in gross sales. Instead, they experienced operational impact. And so examples of operational impact would be an order from a government body, government official, that states, as an example, that non-essential businesses must close for a specific time period, or that residents were required to shelter in place, or that businesses were required to operate with adjustments or modifications to their operating hours, or that they were required to apply capacity restrictions. Maybe, as an example for restaurants, there was a time period where there was no indoor dining allowed. And then there was a time period following that where there was indoor dining, but you had to operate with only 25% capacity. And then it became 50%, and then 75%, and then it was eventually opened up. And so, that fact pattern is going to be determined by two things. One is what kind of business you are, and two, where were you geographically operating? And so one of the things that we've done here at Trusaic is develop a really robust and rigorous qualification framework around that second test, that full or partial suspension of operations. And that's where we're able to really qualify a lot of employers that didn't believe or weren't aware or didn't have the time to figure out the nuances and the intricacies of those rules, and that may have even been told by someone like a CPA or bookkeeper that they didn't qualify for the retention credit because they didn't pass the first test. The first test is the easy test, right? It's pretty simple to take a look and say, hey, did I have a decline in my gross sales? Just comparing quarter by quarter, 2020 and 2021 against 2019. This one is where there's a lot more nuance, and it's really critical. And so our regulatory attorneys have worked to develop a really strong qualifying framework that allows us to enable employers like you to generate substantial tax credits. So we're going to move on into a section around just minimizing IRS audit risk. And I do see some questions in the polls, and I'm just going to address that at the end. So thank you. Please continue to submit any questions in the Q&A, and we'll get to those at the end. Thank you. So in terms of, one of the really important things to be cognizant of is that is the interplay or the connection between the employee retention credit and the Paycheck Protection Program. Because again, many employers did participate in the PPP loan program. And although Congress did modify towards the end of 2020 the employee retention credit to allow employers to claim the credit even if they claim the PPP, there is an important double dip exclusion provision. So what that means is you can't double dip in terms of wages. So if you used PPP loan proceeds to pay payroll costs, you can't use those same payroll costs to then turn around and generate an employee retention credit. And so, as part of the project process, it's critical to identify which wages, if any, were paid for during 2020 and 2021 using PPP loan proceeds, and to exclude those from the ERC calculation. And, that's one of the things that Trusaic assists with. A lot of people think to themselves then, well, if I participated in the PPP loan program, I'm probably not going to be able to generate a very substantial credit. And I would assure you that is not the case. Again, almost 3/4, I would say, of our clients have participated in the PPP loan program at least one round, many of them 2 rounds, and we're still able to generate very substantial credit amounts. And so, just to really drive home the point, although it's great that you're able to participate in both programs, it's just critical to make sure that you've really dotted your I's, crossed the T's, and make sure that you understand down to the employee level and down to the payroll data by check date, which wages are eligible to qualify for ERC if you did participate in that PPP. Otherwise, you are exposing yourself to potential, certainly friction, frustration, and risks with the IRS down the line if and when they have questions about that. And so, you want to manage that risk while also not leaving any money on the table. So that's what's critical to do is make sure that, you're really walking that line where you're getting all the tax credit that you're eligible for, but you're also minimizing any risk. In addition, so the PPP loan, the Paycheck Protection Program loan program is the most notable of the double dipping exclusion disallowances. But there's many others as well, and so it's important to avoid double dipping between the employee retention credit and the FFCRA, which is another government stimulus credit opportunity, the work opportunity tax credit, which is a federal tax credit that's been in place for decades, and a number of other tax credit programs and government stimulus and loan programs, including the R&D tax credit, the restaurant revitalization grant, which many restaurants participated in. And any covered loans that don't apply under any of these other general categories under Section 7A 37 or 7A of the SBA. And of course, as part of our standard just project implementation process, we at Trusaic evaluate all of this to make sure that employers are appropriately disallowing any wages that cannot and should not be used to generate retention credit. One of the reasons why it's important that as you're going through these projects, you're not just kind of shooting an arrow in the dark and taking scientific wild guesses as to what that credit amount should be, is that the IRS has indicated implicitly that that they do care about the accuracy, and that despite their staffing limitations currently, they have made allowances for themselves such that in the future, they would be able to turn around and evaluate and ask questions, certainly propose inquiries about the tax credit refund submissions that were made. They extended the statute of limitations from the standard 3 years to 5 years around the retention credit. Part of that is likely just signaling to employers that, hey, we do want you to not be casual about the way that you claim the credit. We want you to be very rigorous and make sure that you're not intentionally or unintentionally defrauding the IRS of revenue proceeds. And so with that said, it goes without, it really goes without saying that if you're going to work on this, you should work with a vendor that can help you appropriately analyze and document that interplay between the retention credit and any other workforce incentive programs to minimize that risk of audit. And so one of the things that we're really proud of at Trusaic is just the approach that we take to implement projects in the tax credit context. We always reverse engineer the audit risk, and we construct our documentation in such a way so as to be most conducive to being able to quickly respond to any IRS audits or IRS inquiries or any other regulatory inquiries in the context of any of the programs that we participate in. And so for that reason, we have a really great reputation with the IRS, and we deal with the IRS very regularly just as a function of the work that we do, participating in the tax and tax credit space. And so part of the benefit that you get from working with a firm ideally is just that inferred legitimacy, inferred credibility that, as with Trusaic, just from our reputation of having built up that working relationship with the IRS over the last couple of decades. So in terms of just thinking about what types of documentation should be retained, whether you choose to try to do this yourself or whether you're working with a vendor, there should be really strong documentation around the qualifying reasons. So why do you qualify for the credit and for what time periods? So if you're using the gross sales or gross receipts decline to be able to just show that you conducted that test, that you conducted it appropriately, that you included amounts in the gross receipts that should have been included and didn't include anything that shouldn't have been. And then separately, if you're applying based on the full or partial impact to operations due to a governmental order, so as an example, restaurants that face capacity restrictions or other businesses that face capacity restrictions or that had to change their operating hours. There's very specific tests and ways that those qualification methods should be documented, and it's critical that you have all that in order and in one place to be able to then quickly answer any inquiries from the IRS. Secondly, with respect to the employee count calculations, now this is more important for employers that are closer to the margins of those 100 full-time and 500 full-time employee thresholds that we discussed earlier. But the IRS, is just known to ask for verification of. So anytime that they set out employee count thresholds, they are known to really ask for proof and drill down into that. And they have different ways of triggering employers that they may wish to drill down on. So as an example, we know that they often use W-2 counts or other tax filing forms and reconcile those using internal computing systems that are all connected to each other to try to flag for any employers where they think that they want a deeper explanation of why that employer thinks that they meet the qualification threshold. And so we've dealt with this with a number of other tax credit programs, and that's just critical. It's important too, because many companies may shy away from claiming the credit, and so they're leaving hundreds of thousands of dollars in monies. They're throwing that away essentially because they think, oh, I have 130 employees, 140 employees, I probably won't qualify. Well, you want to make sure that you do or that you don't, and document that appropriately and not leave money on the table one way or the other. But if you are going to claim that credit, it's really critical that you work with a vendor that you trust that has performed that calculation appropriately. So earlier in the session, we looked at that company that had 1,400 employees across 35 restaurants. They're able to claim the tax credit. They were able to substantially financially benefit. But it's really critical that all the documentation as to how that full-time count was reached is very well documented. How did we go from 1,400 employees total to 370 full-time employees? Thirdly, calculations to support the amount of the employee retention credit. So first of all, which employees were eligible to generate credit, which wages of those employees and for which time periods were eligible to generate credit, and then the actual calculation against those wages by check date is critical to maintain. And so fourthly, we have the reimbursement method. So, this one's fairly simple. It's just, and now really most the only way to claim the retention credit is using the 941X form to amend the original 941 quarterly payroll tax filings. And we'll get to that in a moment here. But just making sure that you have those original 941s, the 941X amendments that were submitted, and then ultimately records that the IRS sends to you as and when they notify you that first you're going to be receiving your refund, and then secondly you actually receive your refund. So just keeping copies of all of that. And then for PPP borrowers, it's important, and we gather this as part of the standard onboarding process to just gather and store the payroll costs that were used to pay for gather the PPP loan information in terms of what way PPP loan proceeds were used to pay for payroll versus non-payroll costs, i.e. rent and utilities. And it's the PPP loan proceeds that were used for payroll costs that must be excluded from the qualified wage employee retention credit calculation. And looks like we don't have our second poll question here, so I'm gonna skip past this one here. Okay, actually that was my fault. I just hadn't scrolled far enough. So we're going to do a second poll question, and we're going to just ask, were your business operations fully or partially suspended due to a COVID-19 related government order? And I want you to look past this and think a little bit more broadly, because the question can be a little bit strict and misleading. Really, it's, were you operationally impacted in any way, shape, or form? And think of examples like capacity restrictions, changes to your operating hours, supplier issues with suppliers and with your supply chain. So we're going to open up this question now, and let's see. We're going to launch this guy, and we'll give it 30 seconds or so for people to respond. Okay, looks like we have roughly 80% saying yes, and the other 20% saying no. So we'll give it another 5-10 seconds here. We'll close the poll and continue. Okay. Very good. So let's talk now about just the mechanics of actually claiming the employee retention credit. And so while earlier on there was a number of different ways to claim the retention credit, it was possible to claim the credit on your original 941 quarterly payroll tax forms. Now, really the only way that's available to claim the retention credit is using IRS Form 941X. So it's amending your quarterly payroll taxes. One important thing to note is that the 941X can only be submitted via paper filing. So it cannot be submitted electronically. And so that creates processing friction, and is one of the reasons that once you apply for your credit refund, it takes between 4 to 6 months on average to actually get that back, because the IRS is dealing with a very large paper filing backlog, not just with respect to employee retention credit applications, but just across the broad array of tax forms that they receive. And so, we are well aware and in communication with them that they have allocated increasing budget to staffing up and to be able to deal with backlog shortages. But again, just one of the limitations here is that you're submitting this 941X on a paper form. It's not being submitted electronically. Now, Trusaic does create the entire 941X form for its clients, so that you don't have to deal with any of that. And really all you have to do is participate in a quick review session, sign off that you agree that the calculations are correct. That makes its way to the IRS. So we're going to just review what our solution really means, really what we've taken as a differentiated position. And our goal really is to maximize your employee retention credit while simultaneously reducing the risk of audit. And so really the key to doing both of those things simultaneously is to having a very, very deep understanding of the tax code and being able to apply that in a seamless, easy way that is easy for the client to go through. And so by applying the tax code appropriately, we can make sure that we're driving that refund dollar amount as high as legally possible, while making sure that we're retaining all records, not stepping into any gray areas, and making sure that we're 100% confident that we'll be able to defend and substantiate that position that's being taken in the event that the IRS does initiate any kind of an inquiry or audit. And so what that means is really, from A to Z, we guide and manage the entire process. So, we, to the extent that there's multiple, often, many businesses have owners that may have ownership stake in more than one tax entity. And so when that's the case, it's really critical to evaluate that ownership structure and any common ownership that might exist across multiple tax entities, to make sure that from the get-go, you're appropriately documenting the extent to which any one tax entity might be a member of a larger, what's called a control group or affiliated service group. And so, working with a framework developed by our regulatory attorneys, we appropriately apply that. If you get that wrong, you're already off to, your entire foundation is already flawed. And so we see that as a common mistake in the tax credit space generally, and just in compliance, more broadly beyond that. It's really critical that that be performed as the first step. You know, as an example, sometimes it can be to your benefit to actually be reporting as a group, or to be considered to be part of a group with you know, other entities. And sometimes it's not, but whatever the case is, you want to make sure that you document that accurately, because if the IRS performs an audit and right from the get-go, the first thing they check, they find that you didn't do that correctly, that's an immediate red flag. And now they're going to start to drill down into anything and everything else that you provided as part of that application process. And that's exactly what we don't want to happen. So following that control group determination process, we're going to make sure that we're accurately determining the full-time employee counts under that section of the revenue code that the IRS points to, where they're using the look-back measurement method from the Affordable Care Act's definition of a full-time employee. And, you know, just as a side note, we think that they did that just to save themselves time and not have to come up with a new full-time definition. You know, thirdly, documenting that eligibility quarter by quarter, either using the gross sales decline or the operational impact. And, you know, again, even if you experience an increase in your gross sales, right? Even if you did really great from a sales perspective, it's very likely that you may be eligible to participate in the retention credit due to operational impact. You know, a common question I hear is employers feeling guilty or feeling bad, or they feel, you know, strange about claiming the credit if they did well financially. And what they're missing is the broader point that you know, the credit was about more than just making companies whole that, you know, perhaps didn't do well from a sales or revenue perspective. It was about actually injecting fiscal policy stimulus beyond that into the economy to encourage and incentivize employers to continue to hire, to continue to plan proactively, to expand their operations. And that's, you know, really the secondary and maybe larger reason these funds are being made available, is to just create stability in key sectors of industry across the U.S. business landscape. Fourthly, it's identifying qualifying employees and the qualifying wages via those payroll records, conversations with you as a customer if required, and that data and documentation gathering process. So we're managing that. We're making sure that we're offsetting against PPP loans, as discussed earlier, and any other double dipping exclusion provisions. Performing that final credit calculation for each quarter. So it is a separate calculation for each quarter, and then preparing the IRS 941X forms to actually be able to claim the refund for each quarter separately. So if you qualify for 4 quarters, that means we're submitting 4 different 941X forms, and making sure that we prepare audit-ready memorandums that document all of our calculations and the methodologies that were applied. And then in the event that the IRS has questions and inquiries of any kind, we're going to be the ones that answer that and deal directly with the IRS. That's part of our difference. And so turning that into an implementation step framework here, you know, what we have is, again, our first step was we look at those IRS employer aggregations, the control groups, you know, looking at common ownership across different tax entities to make sure that we've established that foundation, applying the full-time count methodology appropriately, documenting your eligibility under either the gross sales decline or the operational impact quarter by quarter, identifying the employees and the wages that qualify, performing that credit calculation for each quarter. We prepare the forms and claim the refunds. For the IRS submission, the 941X forms, we prepare the audit-ready memorandum. And when we get here, so to get from step 1 to step 3, once the client is signed, will take, you know, anywhere from 2 to 3 weeks. For some clients, it's faster because they're really on it. For some clients, you know, maybe it takes 4 weeks, but generally it's in that 2 to 3 weeks. It's you know, pretty streamlined, very simple process. And once we get to the point here where we're submitting the refund request to the IRS, this step 4 is where there's a little bit more of a waiting game. It is generally taking between 4 to 6 months from the point of application to actually receive that refund back from the IRS. And that refund comes, again, it comes as a check or multiple checks for multiple quarters. And then, you know, from there, again, just want to really drive home the point that there's no limitations on how those funds can be spent. And it's not a loan that needs to be repaid. It really just cash directly onto the balance sheet of the company that can be spent, you know, however the organization sees fit. And then lastly, again, to just really drive home that point is that, you know, if there is any questions, any inquiries, part of Trusaic's difference is we completely stand behind our work with our IRS audit defense. And it's something we're really proud of. The reason we're able to do that and offer that as part of our value proposition is that we're just very confident in the work that we do, and we don't toe any gray areas. We know that we're doing everything we can to maximize your credit while fully staying compliant with the letter and intent of the law, and ensuring, again, all the T's are crossed and I's are dotted. So our last poll question here is, would you like to connect with us to learn more about the employee retention credit and our solution? It is, risk-free. One thing I'll share too is that let me launch the poll, open it up here. And as you're answering that, one thing I'll note is a lot of people have questions about, hey, is this, when does Trusaic, do I have to pay you just to do an analysis? And so the answer is no. It's a completely risk-free process to you as a company that might be interested. And what happens is we sign a contract, we perform the analysis of whether you qualify, and if you don't qualify, we simply issue a polite opinion letter telling you that you don't qualify, and we close the project, and there's no fee owed. So we don't collect any money unless you actually get a cash refund from the IRS in your pocket. So I'll leave this open here for another 20 seconds or so, and then I'll flip back to the project step screen. I think we have a couple of questions in the Q&A, and from there, I think we'll be at a point to be able to wrap up the session. Okay, perfect. Thank you for that. And now I'm going to flip back here. I'm going to take a quick look at our Q&A. And we have a question, looks like it was already answered. But one of the questions was, is there a way for us to get a copy of the slide deck from the presentation? We will be emailing all registrants a copy of the PowerPoint post webinar. So you'll be getting a copy in your email. And then the other question was, can my business still receive employee retention credit even though it's 2022? And the answer is absolutely. Although with that said, the clock is ticking from two perspectives. So I would encourage you to move quickly. So the first piece there is that just mechanically, you only have 3 years from the original quarter to claim the refund request. And so the first quarter that you can claim a refund request is the second quarter of 2020, right? And so 3 years from the second quarter of 2020 is the second quarter of 2023, which we're rapidly approaching. And so as we get to the second quarter of 2023 and move forward, you'll have quarter eligibility begin to expire, moving from 2023 into 2024. Now, the second reason why I would tell you to have some expedience here is that Congress has already one time reduced the qualification timeframe of the credit. And so originally you were allowed to claim the credit through the fourth quarter of 2021. They reduced that, and now you can only claim it through the third quarter of 2021. So you could originally claim it for 7 quarters, now only 6. Part of the dialogue that I think everyone is well aware of nationally is the focus on inflation and the effect that fiscal policy stimulus has had on inflation, right? The U.S. government, as a function of just the response to COVID, injected $5 trillion into the economy, and the employee retention credit is a part of that. And so, the last thing that you would want to happen is that Congress says, you know what, we've done enough. Let's turn off the tap. Let's slow this injection of capital into the economy. And one of the ways we're going to do that is we're going to just turn off government stimulus programs. And so that is a possibility. And so that's why we encourage everyone to, if you are interested, it's best to move quickly to get your submission in. That way, you didn't leave money on the table, whereas other employers that move more quickly were able to get the credit. There's a question that says, are employers with more than 500 employees eligible? And yes, absolutely. And I'm going to jump back to this slide here just for a moment. So as an example, this is a real client of ours, right? Employers with 500 plus employees may still qualify. So there was a customer of ours that was a customer on a separate product, and their CPA firm told them that they didn't qualify for the retention credit because they were too large. But when we accurately applied the IRS look-back measurement method, we found that that employer only had 370 ACA full-time employees. So there's a big difference between your full-time employees as defined using the methodology that the IRS asked you to use in this case, and just the nominal count of your employees. Those can be dramatically different. And so by appropriately applying that measurement methodology, we were able to get this client to be able to qualify for the credit and to claim a very substantial credit. And there's a couple of questions about the fee structure. And so our fee structure is a contingency fee percentage of the credit. Generally speaking, that fee percentage decreases as the employee count gets larger. And again, it's a risk-free fee structure where we only bill you if and when you actually receive a refund from the IRS directly in your pocket. Again, in the event that, let's say, a contract is signed and we determine for whatever reason that there is no credit to be able to be generated, right? Either you don't qualify or whatever the case, we simply issue an opinion letter that says, this is our position on the matter. We close your project. You're not billed for any of our time. The only time you actually get billed is if and when you get money as a refund from the IRS. And with that, I think that we've hit the questions and the polls. Again, we will be circulating a copy of the presentation to all of you attendees, and we will be following up with the folks that said they were interested in learning more. So thank you very much for attending this presentation today, and hope you have a wonderful rest of the day, and that this was educational for you in terms of learning more about the employee retention credit. Thank you, everyone. We're going to close the session.